Hello traders, today is June the 22nd. My name is David Hornsey. I'm a market analyst trading, and today I'll be talking about oil and also inflation. All right, starting with the active trader platform, here we have the Brent contract on the daily chart. Got the lows here from the pandemic 2020, then we've got a swing low here from October, November 2020, then we've got November, December 2021. So these three lows here forming a trend line, basically sort of showing how markets in this sort of energy complex rose up in a channel. Then come sort of end of February, we had the Russian aggression into Ukraine, and we saw that the energy prices, shot up all the way up towards $130 per barrel on this Brent contract. Looking to the left, 80% of traders are still trying to go long this market, 20% obviously going short. So we're looking to see if we can fade this cohort. We are seeing that prices have come down from the swing high from 8th of June. We're now currently looking to the left. We are in this compression area. So the compression sort of formed between March, a month after the Russian invasion, into May. And then as it got in towards June, we had this breakout where we failed to make a new high. So we're just waiting to see if any demand's still there, if these traders that took us up to the $122 per barrel, if they're still there to, looking to buy again, essentially buying the dip, or are we going to try and squeeze these retail traders out of their long position by taking their stops, which are no doubt under these swing lows here that form the basis of this wedge pattern. So we're looking to see if we come lower. Obviously, we've got more aggression from Russia. They are selling their oil to China and India. We're asking for the other oil nations to up their supply. So potentially we could get an oversupply. If we get more aggression and potentially aggression towards a NATO country by Russia, then that could kill demand essentially. We've also got the Fed, who are also at the moment trying to sort of kill demand in terms of consumer spending to try and reduce inflation. Today, we've got Fed Chair Powell testimony in front of the Banking Committee and the Senate over the next 2 days. We look here, got a summary which basically goes on to say that these events often take a more political angle, and the chair will have to reconcile how the Fed is able to contain surging consumer prices without dragging the economy into recession. Now, everyone's starting to worry that the GDP growth rate that we saw go from 6.9% per quarter down to minus 1.5%, with the rate hikes that has been expeditedly raising. Then was waiting to see if that continues to kill demand, and then if the economy does cool down too much, basically because of the war in Ukraine and these rate hikes, then potentially we get another quarter in the negative, which then is essentially a recession. So that's what's worrying the lawmakers, because they've got their midterm elections this autumn and they want to get re-elected. If we go to the transcript from June the 16th, the questions that were asked, a lot of them were around more inflationary pressures coming in and whether or not the Fed would try and induce a recession. They were adamant that they're not trying to induce a recession. They are looking for a soft landing. The reason why they raised their rates from 50 basis point up to 75 basis points, as they had signaled, it was only going to be a 50 basis point rate hike. It is basically because the preliminary Michigan reading, he says here, it's a preliminary reading, it might be revised. Nonetheless, it was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we can look at the University of Michigan inflation rate, and we can see here that since 2020, it has been sort of grinding higher. We did have a big exponential move up into May 2021, then another grind, and then another sort of surge into March 2022, April 2022. So the University of Michigan in blue has been rising along with the CPI and the PCE. Now, if we go back to the calendar, we've actually got that revised University of Michigan inflation expectations on Friday, June the 24th. So we're looking to see if 5.4% comes in again after they revised their expectations. If they drop it, then that's good for the Fed. Maybe they don't have to do another 75 basis point rate hike, which means potentially this, the landing in the economy will be softer. If, however, it comes in at 5.4 or above, then that basically opens up the door for the next meeting to be another 75 basis point rate hike, which will then add to this, worry that, we're seeing retail sales basically drop off, go negative. We're seeing consumer confidence drop from 58.4 down to 50.2. Things aren't looking great across the economy in terms of demand, which is what the Fed have basically been trying to do. They don't want to see another quarter of GDP growth rate in the negative. So consumer prices minus energy and food. This is called the core CPI, core PCE. We can see that kind of topped out around February 2022, March 2022. Going back to the active trader platform, obviously we had February, March, consumer prices being lifted by this energy prices, which then topped out as well in March. The recent June swing high didn't make it up to that swing high there. So potentially we have got a lower high. We just need to see a lower low now. So I'm looking to see if we can stop out this cohort, which are long on the retail side, see if we can take out their stops. If we do, then that opens up this imbalance here between December 2021 and February 2022. That gets us back down towards this trend line, potentially even lower. So we could come back lower, test the sort of mid-December lows here before going back up to test that backside of the trend line before going lower. Now, other ways of reducing inflation is to take the money out of the system. So if we look here, when the Fed and the US Treasury were pumping trillions of dollars into the markets, we can actually see that personal savings here in red got pushed higher. So personal savings went up as the money got shoved into the economy. They've now seen that being reduced. Since basically April 2021, they've been seeing their personal savings being drained as tax here. You see the federal government current tax receipts, personal current taxes, that's been rising exponentially. So they're using tax to drain the market of money that's been around the system. They've taken all that out, started to take that out. So that's one way of reducing the ability of consumers to pay for things. But we're also sort of seeing that the unemployment rate has got back down towards the pre-pandemic levels. So the Fed are now happy that anyone that needs a job or wants a job can get a job, and they're willing to sort of sacrifice some of that unemployment rate for essentially raising tax, raising rates, and making things more expensive to kill demand. So if they do that and we get lower prices, then hopefully as we break through the $100 per barrel on the Brent WTI, hopefully they can sort of ease off on the rate hikes. We'll find out if they've got any other ideas of how to kill demand without killing the economy today and tomorrow. So we're just looking to see, like I said, what happens on Friday with that University of Michigan expectations and how price action sort of reacts to this $105 per barrel. So that's what I'm looking at the moment, hopefully looking for a push down in the Brent crude, and then we'll see what inflation does from then on. All right, good luck today, and I'll speak to you again tomorrow.